Hello and welcome to day 3 of the 2024 US Expats Financial Conference, brought to you by AmericanExpatDirectory.com and sponsored by Expat Focus, the web's favorite destination for anyone moving or living abroad. We have a fantastic schedule for you consisting of 9 sessions over 3 days, covering multiple aspects of financial information for Americans living abroad, with perspectives from some of the world's foremost experts in their fields. Today is the 3rd and final day of the conference, and this is our 3rd and final session of the day. And I'm delighted to be joined by Chris Baker of More DM, who will be discussing investing in US tax rules for expats. Before we start, though, please bear in mind the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. Note also, while the conference is free to attend, if you'd like to leave a tip towards organizational costs, you can do so using a card at the PayPal link I'll drop into the chat window at the foot of your screen. Chris will be answering your questions after his presentation, so please add them in the Q&A pop-up throughout. Whenever you think we'll try to answer them all at the end, time permitting. So without further ado, over to you, Chris.
Very much, Hugo, and I'd speak from the bubble of my little meeting room here, but hello to everyone out there. I will attempt screen sharing, bring up the presentation, and if that goes well, I think it'll be smooth running from there onwards. So the topic I'm tasked with today is a very broad one, but it is investing and US tax rules for expats. I'm very much focusing on US citizens because it flips everything the other way if we start talking about non-resident aliens and their US investments. So we are focusing on US citizens as we go. Again, whilst I'm in the UK, we've tried to keep it broad, depending, to cover general things rather than UK specific, but you'll have to excuse me if by way of example, I start dipping into the UK. So I'm director here in London with Moore Doran Mayhew. We're head office is in Detroit. Got a number of other US offices, though the bulk of our expat team is based in Detroit, and we have offices here in London and in Zurich as well. I've given us a little agenda here. It's pretty broad. We'll be looking at the always exciting FBAR and FATCA reporting. What I've broadly described here as regular investments, which I guess is the kind of holdings you would see in a regular brokerage account. A little look at real estate, and then touching on a few other topics as we go at the end. So the FBAR is information reporting, and it applies to all US persons, which we'll explore a little bit. It's very long standing. It came in 1970. President Nixon signed the Bank Secrecy Act in, and I would suggest in the world of paper filing, the level of take up, the actual compliance with it may have been limited to some extent. But as we've moved into an electronic world, these sort of landmarks mean that there is greater and greater compliance. And it's certainly something the US Treasury, the IRS are looking at. They talk of using AI to cross-check account details, FBAR tax returns. Here we have mention of FATCA, the Foreign Account Tax Compliance Act. So again, this was President Obama who signed this in back in 2010 as part of the HIRE Act. The FATCA was a kind of an extraordinary piece of legislation in that it is completely extra jurisdictional. It encourages, perhaps more strongly than that, foreign financial institutions to report to the US Treasury information they hold on US citizens. And partly the political power of the US, they get a lot of compliance from foreign institutions under FATCA. And truth be told, foreign jurisdictions quite like the idea because they can get reciprocal arrangements on their own taxpayers. But FATCA, and as it's evolved, has given the IRS, the US Treasury, access to more and more information on US persons and their foreign accounts. Not long after that FATCA, the FBAR e-filing became mandatory, and the increasing number of reports filed year on year is a lot to do with that e-filing. But before that, they used to be paper filed, and actually, well, they would end up in warehouses somewhere in Michigan. So the form itself that must be filed is the FinCEN Form 114. FinCEN is the Financial Crime Enforcement Network. So it is delegated to the IRS, but the filing is with FinCEN. The obligation to file this report sits with all US persons. So as you should be able to see there, that includes an individual citizen, a resident alien. It also applies to US corporations, including an LLC, to US trusts and US estates. And the threshold for filing, which is what causes so much pain, if a US person has a financial interest in or signature or other authority over at least one financial account located outside the United States, and the aggregate value of the foreign account or accounts exceeds $10,000 at any point in the year, then the FBAR Form 114 needs to be submitted. That $10,000 is really a tiny amount, and that has been the same number since 1970. That it's never been inflation indexed, and the bar for filing is therefore pretty low, which pulls almost all US citizens abroad into this filing regime. Now, the big issue, and it's been litigated, is the potential penalties that apply to this. So that the filing deadline follows the individual tax return, so starts the 15th of April. The extension to October, the 15th of October, is automatic. You don't need to file anything. So effectively, all US persons with this filing obligation have until the 15th of October to submit a report. There is no extension beyond that. So for US taxpayers living outside the US, there's potentially a tax return extension to the 15th of December. Don't tell my boss that. He's in Michigan and doesn't believe in that deadline, but it is available. So it must be noted that the FBAR doesn't go beyond October unless we're dealing with federal recognized natural disasters where special extensions might apply. So 15th of October is drop dead. It's an individual filing. So married couples each have to file their own reports. And if it's a joint account, the maximum balance is not halved. They each report the full balance. So it's a snapshot. And again, a lot of people have issues along the lines of worrying the IRS think they've got way more money than they have because they might have transferred the balance from one bank to another. That same balance is going to be reported twice, but it's just a snapshot they're looking at. And definitely worth noting there's no age threshold. So minor children could have their own FBAR filing obligation. If they've got foreign accounts or account that has a balance that any time in the year exceeded $10,000, then there is a filing obligation. With, again, as always with the US, we're looking at a calendar year. So it's calendar year 2023. FBARs are initially due 15th of April coming far quicker than I care to comment on, but automatically extended to the 15th of October this year, 2024, to get the FBAR in. So this is the big concern with FBARs, and given the level of non-compliance that existed in a pre-FATCA, pre-e-filing era, you could be fairly comfortable that although the penalties were out there, they were rarely assessed unless we were dealing with real criminal fraudulent behavior. Now there is more and more information. We do see these penalties assessed. There have been court cases recently dealing with FBAR filing. And a lot of people, it entirely depends what country you live in, but penalties for late tax returns are geared to the tax liability. So if the tax has been paid, or if there is no tax, then there is no penalty. The FBAR's information reporting, we'll touch on a few other information reporting forms, but the information reporting for foreign investments, accounts, companies, that's where the real penalty threat, the exposure is. Because it doesn't matter if you owe the US tax or not, these penalties are fixed. There's two sort of routes for penalties under the FBAR rules, which it's a phrase that comes up quite often, but this talks about willful and non-willful. So willful is a deliberate, conscious avoidance of a reporting obligation. Non-willful is broadly accidental, unintended. I couldn't get the information, I forgot. There's again, in court cases, there's a bar where these phrases are defined, but then there needs to be a deliberate act with willful failure. So where we're looking at the non-willful failure, we're talking, well, it's up to $10,000, but they actually index link this. So I believe for 2024, currently, the maximum penalty is $16,117 per violation. The Bittner case I mentioned here from a year ago was actually a win for the taxpayer. The IRS had been seeking to define a violation on a per account basis. In the Bittner case, the Supreme Court ruled that the penalty only applies on a per form basis. So that $16,000 is one annual failure. It is not, if you've got 15 accounts, it's not multiples of the 16,000. and that there remains in place a delinquent FBAR submission procedure. If you are late with FBARs, you can file with FinCEN in the explanation for why you're late. You check other and you'd put a description stating you're filing under the delinquent FBAR rules. That's separate. If you're also late with your tax returns, then you need to look at the streamlined filing procedures, which also cover late FBAR. But if it's just the FBAR and there is no income omitted from your tax returns, then you can use the delinquent FBAR submission process. Then back in 2013, it's effective from tax years 2011 going forward, sorry, the cousin of the FBAR came into being. Again, this is under FATCA, and this is Form 8938, which is the Statement of Specified Foreign Financial Assets. There are some differences between what needs to be reported on an FBAR and 8938, but there is very broad overlap. The distinction between the filings is the 8938 forms part of your tax return. The FBAR is an entirely separate filing. Again, there are penalties that attach potentially for failure to disclose assets, but more likely with reasonable cause arguments to be able to get those abated. If there's no income tax return required, then regardless of the value of foreign assets, no 8938 is required. There's different filing thresholds if you live in the US or you live abroad, and we've just got these over on the next page. So here you can see for a domestic, a US resident, we've got much lower thresholds. For an individual, single filer, married filing, separate filer, it's either of $50,000 value on the last day of the year or $75,000 at any time in the year. That doubles up for married filing joint. For an expat, a US person living overseas, the thresholds are 200 on the last day of the year, 300 at any point in the year. And again, those double for a joint filer living abroad. So 8938 and FBAR, that's information reporting. They have different thresholds. They cover the same ground. The IRS and the US Treasury want to know what Americans are keeping outside the US. So I'll now move on to what I've termed regular investments. But again, we'll see what we're dealing with here. And so these are really the tax treatment we're concerned about here. I'll probably say that other times during the course, but I am a tax advisor. I do not give investment advice. We give tax advice on the treatment of the investments for tax purposes. The easiest asset, the friendliest asset from a US tax perspective would be listed securities. Shares on an exchange. Then we're dealing with regular capital gains rates. So less than 12 months holding period. You've got the US short-term rate, which is your marginal rate of tax on ordinary income. Long-term gains, that's up to 20% tax rate. You've then got the net investment income tax, NEAT, at 3.8% on top of that for US citizens. The dividends paid by a foreign corporation, As long as it's a treaty country, those dividends are also eligible for the qualified dividend rates. So again, the long-term capital gains rates on that income. When we're talking about income tax, then the sourcing, when we're dealing with your foreign tax credits, the sourcing of gains for what are described as personal property are sourced to the resident of the taxpayer. So not where the shares are held, but where the taxpayer is resident. There is a carve out if the foreign tax is less than 10%, then the gain will automatically default to US. That can create some complications where foreign tax has been paid, but at a rate less than 10%. And then you need to look at the resourcing provisions of the relevant US foreign country tax treaty. So next up, and again, this is really where we're stepping into the danger zone, as I believe Kenny Loggins once described it, but we're looking at mutual funds and ETFs. These are a pretty regular investment in any US portfolio. And for expats, it really depends what the country they are living in outside the US thinks about those sorts of investments. If you're in a US portfolio, then it may be that the foreign country isn't going to tax it at all. The remittance base is in the UK. The expats deals in Italy and the Netherlands come to mind. And then you're safely invested in the US and there's no threat to punitive treatment in the foreign country on your US portfolio. Where you get into foreign mutual funds or ETFs, then we are into the world of PFICs, passive foreign investment companies. And we see this regularly because the local jurisdictions given no consideration to the US. These are the standard investments. And if they're not in a tax protected wrapper from a US perspective, then they're going to suffer what is a punitive tax rate. I mean, an example in the UK is the stocks and shares ISAs. What those tax-free investments in the UK invest in are almost always PFICs from the US perspective. The life insurance contracts in France, which in that civil law jurisdiction are pretty regular estate tax planning tools. Again, they're not qualified life insurance in the US. So the wrapper is looked through and lo and behold, inside are PFICs. If you are talking to an investment advisor in a foreign country, it's always worth asking about PFICs, because if they stare blankly at you, they're probably not the people who should be advising you on your investments. So it's a good test because an American does not want to end up invested in a PFIC. There's essentially no way out once you're in, and the tax treatment it can be costly. Here we kind of define what a PFIC is. When we're looking at these collective investment vehicles, open-ended investment companies, unit trusts, like they're always going to be these. They're going to be producing passive income. So I don't think we really need to dwell on the definition of a PFIC here. What we do care about is how the US taxes them. So the default taxation, whenever there's a distribution or a gain is realized, there's a throwback tax calculation. So the gain is treated as accruing over the holding period. So if you've owned it for 10 years, then 10% of the gain is allocated to each year in which you hold the investment, and 10% is taxed at the highest rate of tax, ordinary income rate of tax, so 37%, 39.6% in each year. On top of that, they charge late payment interest as if you should have paid it in the year that the allocated portion of the gain accrued. So if you've held it for 10 years, then 10% is going to have interest charged for 10 years, another 10% charged for 9 years. And I mean, you can see there, the tax and penalty combined are limited to a generous maximum of 100% of the income. So these really are painful investments for a US taxpayer. There are a couple of elections available to mitigate the worst of these rules, but they're not always going to work. So the first of them is the qualified electing fund, the QEF election. It's very unlikely you're going to be able to make a QEF election in respect of a listed unit trust. Generally see these elections where you're looking at sort of a startup company, an investment that maybe it's got 20 investors, 2 or 3 of them are US, so we're not in the controlled foreign corporation world, but those individuals will have some power to get the financial records and make the necessary statement to the IRS. The mark-to-market election is more readily available. You have to have marketable security sold on a public securities exchange. Both elections, you are effectively recognizing unrealized gain and income. You are avoiding the deferral of income abroad, which is what the IRS are particularly unhappy about and why the PFIC rules came into being. Once you've recognized the unrealized gain, that creates your basis. So when you ultimately sell, you're not going to be double counting that income. But it's not my favorite tax planning to pay tax on unrealized income and gains when you don't have the cash to pay the tax that might go with it. Skipping on, as I know we want to get to Q&As, just a couple of slides on owning real estate, which again, we're looking at relatively neutral. We're dealing with short-term, long-term gains. There's our friendly net investment income tax again. It's the holding of the investments in real estate that I will touch on, because that brings up more of our foreign information reporting, and with it, those penalties that are not tax geared. We're dealing, when we're talking about real estate property, we're dealing with real property rather than the personal property the securities were. And real property is sourced where that property is physically located. When we're looking at a main home, and this is a situation where we'll often see a US tax liability accruing, because the US offers an exemption on a qualified main home, which is essentially if you have owned and used it as your main residence for 2 of the last 5 years, then you qualify for a $250,000 exclusion against the gain. That doubles up for married filing joint to 500. But any gain over and above those exclusion amounts is subject to, in all likelihood, the long-term capital gains rate. The UK sale of a main home is fully excluded from charge to capital gains tax. I know in Switzerland it tapers down to virtually nothing, depending on how long you've held it. So there's often positive tax answers in the foreign jurisdiction that are not matched in the US, and you can see a US tax liability on the sale of a main home. That last point there, again, it depends where exchange rates have moved, but this is something we've seen a lot of in the last few years. The foreign mortgage is a separate asset from the property itself, where you redeem your mortgage, where you pay it off. If the exchange rate has moved in a certain way, you will have a taxable gain on the redemption of your mortgage. So if you borrowed in sterling when the exchange rate was 1.5, you borrowed £100,000, that's $150,000. You repay it when the exchange rate is 1.2, £100,000, but it's $120,000. As far as the IRS are concerned, you've got a $30,000 gain that they are going to tax. Now, if you've got excess credits in the general basket, then you can probably source the gain in general and offset that, but it's something to be aware of when you are redeeming a mortgage and when you're selling property. Again, with rental property, the US treats rental property as a depreciable asset and gives you a deduction for that depreciation. If the property ends up appreciating, you have to add back the depreciation, and you add back the depreciation allowed or allowable. So you're pretty much forced to take the deduction combined with the mortgage interest deduction. That will often create a loss for US tax purposes on the rental property, suspended generally under the passive activity loss rules. In the foreign jurisdiction, there is very unlikely to be an equivalent to depreciation. So what's a loss in the US might give rise to taxable income in the foreign country. So again, that's something to have in mind. That mismatch is not necessarily the same treatment in the US and abroad. So this touches on how property is owned. And in the US, particularly with rental property, the limited liability that an LLC avoids sees it as almost a standard way to hold the property. It's completely looked through for tax purposes, but you've got the legal protections in what may be litigious environment. That LLC will have different treatment in the foreign country. So that's something to watch out for. It's likely that there will not be an equivalent look-through treatment, and then you're looking at distributions from a corporation rather than a simple rental income, less expenses. Not really relevant for our purposes, but non-resident alien owning US property through an LLC is going to find themselves with additional reporting obligations. And this is the flip side of that. What is typical in your local foreign jurisdiction where some form of entity might be used to own the property? Again, as I said, I've leaned into the UK here, but an individual who rents out a property, they are limited on the deduction they can get for mortgage interest. It's limited to the basic rate of tax. If that property is owned through a company, there's no limitation on the deduction. So inevitably, there's a move towards owning property through a corporation. But if a US person does that, they've just created a controlled foreign corporation. They've got a 5471 filing requirement. They just increased the cost of their compliance and complicated their US tax position. French example here, it's common to use an SCI. That, under default rules, is considered a foreign partnership by the US. There's another set of information reporting. There's an 8865. That has penalties like a 5471 does. So always be wary as a US person abroad. If you start using foreign structures, take advice before you do it, because it might be the typical treatment in your local jurisdiction, but it might create US tax problems for you. The very broad other considerations to touch on. I mean, pensions is entirely dependent on the tax treaty between the US and a foreign country. If there's a tax treaty in place, it may be that foreign pensions are actually a good place for you to be invested, because most treaties have some form of pensions article that will see a plan qualified in one country being recognized in the other. So that really is difficult to generalize on that, because it is specific to your treaty. If there's a treaty, then the pension may very well be effective and tax efficient. Without a treaty, the pension vehicle will be ignored. You're looking at what's inside the pension, and those are probably PFICs. Digital assets, as it's broadly termed, it's something I think as any baby boomer or Gen Xer out there will know. Not something we know a great deal about, we're learning about, and that's how the IRS feel about them. They treat them as regular capital gain, short-term, long-term. There's net investment income tax, but they are always gathering information. For some years now, there is a question right at the top of the 1040 under the filing status, asking if you hold, if you receive, if you recognize income on a crypto exchange on the disposal of digital assets. So they're gathering information about it. They're now requiring the crypto platforms to issue 1099s. Those platforms haven't quite worked out which 1099s they're supposed to be using. The IRS are still working it out, but it's something they're wary of. And again, definitely needs to be going on your FBAR and on your 8938. So for any expat, living with different currencies is always part of the story. If you're looking at pension planning, where you retire, do you want your pension assets in US dollars? Do you want them in the foreign country? What's going to work for you? But as far as the US tax code are concerned, there is only the US dollar. We saw that with that example on the mortgage gain. The movement of currency is always an issue. And if you're actively trading foreign currencies, but you're not a Forex trader where it's your business, but if you actually trade an account, then you're getting capital gains treatment. What I really wanted to point out here is this reportable transaction disclosure, Form 8886. Some call it the please audit me form. The thresholds for that in most instances, there's a lot of different reportable transactions, but the foreign currency loss is noticeably low compared to everything else. So if you have a $50,000 loss in a tax year, then you have an 8886 reportable transaction disclosure to make. So again, that's foreign currency loss, but it's something to bear in mind. And we've avoided non-resident aliens, but I thought we should touch on this because where there is a marriage of a US person and a non-US person, that's immediately complicating their investment world. I mean, the simplest advice is to keep the investments that each individual makes separate, so that the US person is not getting caught by the punitive rules that might exist, the PFICs, whether there's suitable treaty arrangements in place. So it's something to be careful of. And again, talked mainly about income tax here, capital gains. We haven't really had to worry too much about the estate tax, but where you have a non-resident, non-citizen spouse, US estate tax suddenly becomes a very big issue. The threshold for a non-resident, non-citizen with US citus assets is only $60,000 compared to the $13 million or thereabouts that a US citizen enjoys. So that's a bit of a whistle-stop tour there. But I wanted to leave time for some questions before I disappear back into the ether. So thanks for listening. And
Chris, thanks very much. That was awesome. Lots of really interesting detail and covering lots of topics that I wouldn't suddenly normally think of, from real estate and currencies and cryptos and so on. Thank you very much. So let's dive into the Q&A. There are lots of questions. Let's see if we can get through some. Okay, here's one to start. Lots about PFICs. Are all life insurance policies PFICs? And how do you know?
I was going to talk a bit longer to reduce the number of questions, actually. Now I think about it. No. But it's not the life insurance policy that would be a PFIC. It's what the life insurance policy invests in. So it's the problem that US persons overseas investing in anything that is foreign, is the wrapper recognized by the US? If the wrapper, in this question, life insurance policy, in the UK, it might be your ISA. In France, it's l'assurance vie, so that is a form of life insurance. That wrapper isn't recognized by the US, so you ignore it and you look at what's underneath. And the nature of these investments, be it life insurance, be it pensions, be it an ISA, whatever the other, is they're in those sort of mutual fund, unit trust, ETF, those foreign versions, they're almost certainly invested in PFICs. Life insurance is very particular in how it's defined in the US under the code. It's qualified life insurance, and as far as I'm aware, there are fewer treaties that give the reciprocal treatment. So life insurance can be problematic, foreign life insurance, and it will be the investments in it. It's the same with pensions. If the pension's not got a treaty to protect it, it's probably in PFICs.
Yeah. So there were specific questions about, whether all or not necessarily all French assurance V's are PFICs, and it sounds like, as you were just saying, it depends what's in them.
Yeah, it's not the wrapper, it's what's underneath them. So if the US will respect the wrapper, most likely under a treaty, because foreign life insurance is not going to be qualified within the terms of the Internal Revenue Code.
And then I suppose that applies for all countries. Somebody or a couple of people have asked about mutual funds and ETFs and pension plans in Canada. But I suppose the same applies. It's what's in it.
Well, so pensions, and I am not going to claim to be. I know Canada has very particular rules, being near neighbour across the. Well, my firm's head office is in Michigan, so Canada is literally across a bridge. Tax treaties have pension articles that will often allow reciprocal treatment where you don't have to worry about the underlying investments. So a pension is the most likely vehicle, he generalized broadly, to be recognized as qualified as far as the US are concerned. So the tax treaty modifies the code, the tax code, and you end up with a vehicle in the form of a foreign pension that the US recognize, and then you don't have to worry about what's going on underneath the wrapper because they've respected the wrapper. But with the life insurance, they probably haven't respected the wrapper, and then you need to worry about what's happening underneath it.
The herd. There's somebody else, how to calculate and report gains or losses on foreign investments if the tax year and calendar are not the same, which is the case in the UK. So they get UK tax transactions reported from April to April and have to report in the US January to December. How do you do those calculations?
Ideally, you've got a friendly wealth manager, investment advisor who's doing the calculation for you. I know there are firms out there that produce calendar year and fiscal year reports, but otherwise you send it to your friendly tax advisor and they stick it in the Excel spreadsheet, translate purchase date, sale date. But the US, you're looking at the calendar year, where that, and again, without dwelling too much on the UK, because most of the rest of the world have a December fiscal year, just like the US. So most people in the world claim an accrued basis of foreign tax credit at 31st of December, and the 2 years match. The UK, with its 5th of April year end, that does create a particular problem with foreign tax credits and realizing gains. So generally speaking, if you realize the gain in the first quarter of the year, 1st of January to the 5th of April, then the gain's going to be in the right year for foreign tax credit purposes. If you recognize it later in the year, it's going to end up being taxed in the US before you've accrued the foreign tax. So that is a problem for a UK taxpayer. If they're on a paid basis for foreign tax credits, then again, they're probably having to accelerate the payment of the UK tax. So the April to April, it's annoying in terms of getting your data together, but the US only care about the calendar year. It's the foreign tax credit that really is an issue with that UK fiscal year.
Okay, some questions on FBARs. There are a couple I'll group together. So one is not married but joint bank account abroad, file taxes separately. So both need to file an FBAR. Before you answer that, there's a similar one or a related one. Somebody who's treasurer or runs a club of which they have control of the bank account, and again, do they, even though it's not their money, do they have to report that on an FBAR? So yeah.
So these are US persons, and the answer is yes, they need to report. So where you have individuals, if they're both US, they've got a joint bank account, they're not married, then they probably, off the top of my head, there's a little more detail they need to put in about the joint owner because the US want to link them up, but each individual will report the full balance of the account. It's just information. It makes people uncomfortable, but each individual, and in the case of the treasurer for the local club, he or she has signature authority over a foreign bank account. If you look at the FBAR forms, you see there's a separate section for reporting those types of accounts as opposed to the ones you actually own yourself. So it's split. You've got the individual owned, the joint owned, and then there's a signatory authority section. But yes, and $10,000, they've never increased it. There's been a lot of call for it over the years. They've never done it. They show no inclination to do it. They can just absorb this information, get it in their system. They don't do anything with it unless they need to. But it's out there. It's
yeah,
egregious, some might say. Certainly painful to get it all together. But that's where we are.
So yeah. So another FBAR question: if you maintain foreign bank accounts after you move back to the US, so you're no longer living abroad, do you still need to report them and file an FBAR?
You certainly do, and in all honesty, a person in the US with foreign bank accounts is someone they want to know even more about. So when we saw with the 8938, it's got much lower thresholds, well, half the limit compared to the person who lives overseas. There's some understanding that someone who lives in a foreign country might need a foreign bank account. There's less understanding someone in the US having a foreign bank account. So I would be very religious in my filing of those reports if I was living back in the States.
Lots of questions, but you've answered about the French assurance vie. What can EU citizens do with regards to PFICs, given that MiFID II rules don't allow holdings of ETFs in the US and PFICs are not allowed in Europe? Where do you invest, I suppose?
I mean, this is the difficulty. Again, I can't give investment advice. I can tell you the tax consequences. The tax consequences here, of course, the problem, you just have to find the right investments. If you can just Apple stock, Coca-Cola, whatever it might be, or you need to find the right investment advisor, wealth manager, because those firms are out there who specialize in dealing with individuals who've got these issues, and they will know the right products that are tax friendly in your local jurisdiction and in the US.
We had a couple of investment advisors specializing in US expats yesterday doing talks. So anyone interested in sort of how to invest there, it's definitely possible. And on the US Expat conference website, you can find out who they were and get in touch if that helps. Somebody else, excellent. What would CDRs be considered?
As in cash deposit,
I guess.
Yeah, I mean, if we just, cash is fine if that's what we're talking about. If I've misunderstood, I apologize, but cash, interest bearing, taxable interest in the US, credit if it's also taxable in the foreign country.
Yeah. Well, maybe come back to that. I'll have a look into it. So yeah, advice about crypto assets, but you covered that, I think, and reporting them.
Yeah. At this point, and it's the same in most countries, it's a capital transaction, but they're wary of it. They're gathering more and more information on it. There's a lot of international government level discussion around the taxation of digital assets, because the issue with digital assets, where are they sourced, and that who gets to tax them? And there's a lot of negotiation going on at a government level about that. And in fact, the US changed their foreign tax credit rules, but they've rode back on that currently for consultation. But that's all about digital asset tax. So this is really an evolving area. But that's about the sourcing of where the gain is rather than what it is. It's a capital gain.
Coming back to CDRs, it's a Canadian depository receipt. Type investment allows Canadian investors to purchase shares of global companies that are normally listed on foreign exchanges. I'm not sure if that would obviously be what the reporting requirements would be on.
Yeah, I mean, that feels like it's a mutual fund equivalent and is going to have, I don't know if there is anything particular in the Canadian treaty that might help that. The Canadian treaty is a little different from the regular treaties because of the close proximity and the fact that people commute between the two. But
okay, somebody else, back to PFIX. You said no way out once you're in, and the person said, I had PFIX. I found out when I found out about them, I sold them. Am I now okay?
Well, I mean, at the point of sale, then the default taxation, the Section 1291 taxation would have applied. Depends what the holding period was. Well, once they're sold, but whether they were taxed correctly at the point of sale, I guess, is the open question. But once they're sold and taxed, they're done. But gifting them does not solve the problem. Expatriating does not necessarily solve the problem. Dying does not necessarily solve the problem. There's not getting into them, getting out of them, having losses solves the problem, I guess. So if the currency moves a certain way, but you probably want to not hold them unless their investment return is such that it outweighs the potential tax and interest consequences.
Yeah. Okay. Somebody else, if you're American living abroad with a non-US spouse and they hold foreign investments, is there a kind of reporting requirement in the US?
No, they are all good, but you are keeping your marital assets separate, and there's all sorts of non-tax reasons why that is good and bad. But as your tax advisor, if you are a US person, you keep your investments in the US, and your spouse can have their PFIX, their mutual funds, their ISAs, tax advantaged. That's all good.
Somebody else, how long is FBAR information kept by the US government? Is it more than 10 years? Is there a limit on that?
I do not know that off the top of my head. I don't think there's a statute. Well, if you haven't filed, there's no statute. I don't know if they dispose of it now. It's electronic. I would have to check that.
Yeah, it's an interesting one. Could you discuss WEP windfall elimination provision as it relates to pensions? Does that make sense?
That doesn't.
I don't know what that is. It's the WEP. Again, I'll look that up in a sec, see if we can shed some light on it. So a pension from a German company, they're paid out sort of, I suppose, annually rather than as a lump sum.
Mm-hmm.
Are they protected or are they taxable and reportable in the US? It's a company pension in Germany.
I'm presuming, correctly or not, I'm presuming that it's taxed in Germany on distribution. It's probably tax deferred on contribution into the plan. So Germany taxes the distribution. You're a US person, so you're also taxed in the US on the same. The foreign tax credit should be your savior there. Under general treaty terms, that I'm pretty sure Germany is covered here, where you're getting regular periodic payments from a pension where the individual is resident dictates who has the primary taxing right. So in that scenario, I'd expect Germany to tax it. The US will also tax it, but give a credit for the German tax.
Well, we've kind of gone over the hour, so let's just do one more, and it's a PFIC one. And just to reiterate, somebody else, is there a list or a way of knowing which foreign is there a list of PFICs that the US government produces, or otherwise, how do you know for sure?
How do you know for sure? I mean, that's you. The vehicles that they use, anything that sort of mutual, where you've got a company or what's considered a company owning, what they're broadly doing is that they're buying up investments in lots of other companies. That the vehicle that's doing that, the mutual fund, is purely got passive assets. It's a passive foreign investment company. The US do not publish a list. There's an equivalent list for reporting funds in the UK. HMRC over here do publish a list of what they recognise and don't recognise, but the US do not. And the PFIC rules can catch trading companies. There are certain startup year exceptions, but I forget which it was. I think it might have been Fiat, but a big European car company became considered a PFIC by the IRS. And once it's a PFIC, it's always a PFIC. So I'm afraid there isn't a list. They're not going to make it that easy for you. It's self-assessment. They're telling you to work it out, and then they'll come and tell you if they didn't like how you worked it out.
So I guess, it's a question of sort of, to be safe, finding some advice from somebody who's experienced in this area in your country.
Yeah, I mean, anything as a collective investment type scheme is almost certainly a PFIC. So it's making sure that either the wrapper, be it a pension, is recognized by the US and gets qualified, you don't have to look through it, or making sure your investments are in either something that is US approved, so in a US portfolio, and clearly that might create problems in your home country where you live, but or you just have securities. But life assurance, pensions, they don't tend to start stock picking.
Well, look, we've run out of time. If anyone has more questions, what I'll do, Chris, did you want to drop your email into the chat, or shall I drop the more DM website? I'll do that anyway.
Yeah, don't do.
And reach out if you have questions about your specific situation. And well, Chris, thank you very much for the fantastic presentation and answering all those questions. Thank you to everyone for joining us today.